Ever wondered how big companies raise big money without giving up control? Well, they do it by issuing bonds. But what are bonds? Let's break it down. A bond is basically a loan, but instead of borrowing from a bank, a company borrows from many investors. Companies issue bonds to finance large projects, expand their business, or manage cash flow, all while keeping ownership of the company unchanged. In this video, we will explain how bond issues work, why companies use them, and why it matters in corporate finance. When a company needs funds, it can issue bonds instead of taking a loan from a bank. Here's how it works. The company decides the face value of each bond, for example, $1,000, and the total amount of it wants to rise. It sets a coupon rate, which is the interest paid to investors annually or semi-annually. It determines a maturity date, which is when the company will repay the principal. For example, if company XYZ issues 1,000 bonds at $1,000 each with 5% annual coupon, it rises $1 million today and pay investors $50 per year per bond until the bonds mature. But not all bonds are the same. There are several types, like corporate bonds issued by companies, government bonds issued by governments to fund public projects, secured bonds backed by company assets, and unsecured bonds not backed by assets. Companies choose the type based on their risk level, investor confidence, and purpose. Companies issue bonds for strategic reasons, like raise capital for expansion without giving up ownership, refinance higher cost debt at a lower interest rate, and fund new projects or acquisitions. For example, Apple and Tesla have issued corporate bonds to fund operation, research, and large projects, even when they have cash available. This shows that bonds are used strategically to optimize a company's finances. Investors buy bonds because they offer fixed income and are generally less risky than stocks. Bond prices can change based on interest rate, credit ratings, and market conditions. When interest rates go up, the price of existing bonds usually goes down. When a company's credit rating is low, it must offer a higher coupon rates to attract investors. But before we end, let's look at a common question investors ask. Should you invest in bonds or stocks? Stocks give ownership in a company and can provide higher returns, but also come with a higher risk and price volatilities. Bonds, on the other hand, provide a fixed and predictable income stream with generally lower risk but also lower potential returns. Think of it like this. Stocks are like riding a fast motorcycle, higher excitement, speed, but more risk. And bonds are like driving a dependable car, steady, predictable, and safer for long-term stability. So in summary, a bond issue is an essential tool that helps companies raise money efficiently while giving investors a stable source of income. By understanding how bonds work, the different types, and the factors that affect bonds prices, both companies and investors can make smarter financial decisions. Bond issuance remains a key part of corporate finance because it supports growth, reduces financing costs, and strengthens long-term financial stability. Thank you for watching. We hope that this helped you clearly understand how bond issuance works and why it plays such an important role in business world. Bye!